Yeah, we won't wait that long because people normally.
Either get on or not, huh?
Yay. Okay, we are live. So we'll just give it like a couple minutes
Alrighty.
for people to hop on. Okay, is this good? Yep. All right, we have some people hopping in already. Welcome. Thank you for joining us. We are just going to give a couple more minutes just so we can have let more people in. So thank you guys. Okay, I had to run and get my water really quick.
It's a must.
I know. Okay. Again, thank you guys for joining us. We will start shortly. Okay. Perfect. Have the comments. Okay. Okay. Well, it's 7:02. We're just gonna go ahead and get started. We'll let people hop on while we're doing this. So really quick intro. Hi, everyone. Thank you so much for joining us this evening. My name's Yadi, and I am the digital marketing specialist here at Foothill Credit Union. And today we have another live event for you guys. We are really excited because we have a very popular topic currently, which is our HELOC, also known as home equity line of credit versus home advantage loans, and what's the difference. And today, to help us understand a little bit more about them, we have our consumer lending manager, Michael Arispe, that's going to give us all the knowledge we need. So, Michael, go ahead and take it away.
Perfect. Thank you, Adi. I really appreciate that. And as you stated, it's a really hot topic right now, so we really wanted to dive into it. Some people say, yes, they're similar products, but when you kind of narrow it down, they're not too similar, right? They're both using your equity. And people always hear, I have equity in my home, but how am I tapping into it? And how does it benefit me? And what program's best for me? So what we wanted to do today is compare apples to apples, compare those two programs. And so members could make that educated decision, what fits their need, right? So let's get into it. So as I stated, they're very similar in one product is that both use your home equity that you can borrow up to 80% of the loan to value. And I like to say combined loan to value. So what that means is if you do have a first, what you owe on your first mortgage, you take the 80% of what the value, the appraisal is, and how much you want to borrow. And those together cannot go over 80%, right? So, and it's combined. So some people look in, they go, oh, I have equity in my home, but they forget to add in that they already have a first mortgage, right? So they want, my home's worth 500,000, I want 500,000, but you have a first mortgage of 300,000, right? So we have to subtract that out and then back into the number that you can. So now that we know those products are very similar in that aspect of that we use your home's equity and you could loan up to 80% combined loan to value. Now let's kind of dive into it and see what are the differences, right, in the two products. Let's go into the home equity. Very strong product, right? This is what people really know. This product, this is what you see what's out there. What it is a revolving line of credit, but with a variable interest rate, right? So that means obviously your rate can change, right? It's tied to prime rate. That's the rate you hear a lot about on the news, that prime rate's going up. This product is tied directly into that. So when prime rate goes up, your rate goes up, right? But on the flip side, it can also go down, right? Prime goes down, your rate goes down. So we saw that for a long time. Prime rate was at 3%. So you were taking advantage of that if you had a home equity at 3%, which is an outstanding rate, right? So we have seen it go down, and right now we're in a trending market where we're seeing it go up, right? So that's one thing to take into consideration, that it is tiered based on prime. It can go up and down. It is a 15-year loan with a 10-year payback. So that means that we amortize the payment. Your payment is based off of 15 years, but you can only draw on it. It's available to you for 10 of that 15 years. After that, it goes right into repayment history, payment, right? You got to pay it back. And the good thing is with this one is you only pay on what you use, right? So let's say you go in there and you get your home valued, you look at that 80% and you go, you know what, we can lend you $400,000, right? What happens is we open up a line, as we stated, that's revolving, sits there for you, and you only pay on what you use. If you don't touch it, what happens? You don't have a payment, right? It's a good, safety net. If things come up, home repairs, or you're looking to do it down the road, and you go, okay, well, I want to have this money ready, right? Because as you know, today it's very hard to get contractors out, and everybody's backed up. Everybody's looking to do projects. So what happens is, when you get that contractor, you have that money ready to go. You just say, okay, here it is. Let me write you a check. I have my home equity already locked in. It's sitting in an account. Boom, let's make a transfer. I'll pay you out, right? And again, that's when you start making payments on it, right? But again, only on what you use. And another awesome thing about this product is when you pay that back, it's available to you again. It's revolving. Remember, for that 10 years. So what happens is, let's say you use $5,000, you paid it off in year 2, you paid that off. It's available to you again, right? So it's consistently available to you when you make a payment. So that's a really strong thing. And I think that's what members really love about this product, is that they can take it. If it just sits there, they don't pay on it, right? But it's that good safety net, right? But some of the things on that product is, again, you could loan up to 500,000. So we do have a cap, right? And you do want to look at that. We talked about that it's an adjustable rate. So you dive into that, right? You say, okay, my monthly payments is based on the amount I owed. It's a variable rate, but it can go up and down. So this product is built for somebody that's very comfortable with that, familiar with it, and maybe that can see that the great product in that as well, that rates don't always go up. We saw them for a long time go down, right? And you took advantage of that. Right now we're in that rising rate environment, so you're seeing that rate go up. Now, if we go into the actual home advantage, right? We'll kind of click into that. Yari, if you put up that slide, we can kind of go into the benefits of that, right? One of the main things is it's a fixed rate, right? And people go, wow, you guys offer a fixed rate product? We do. We offer a fixed rate product for our members. It's a home advantage. And same logistics of it is you can borrow up to 80%, as we talked about, but the difference is that the rate is fixed. But also on that difference is, immediately when you fund that loan, we advance it, right? We give you that money. So let's say you wanted $100,000 and the value supported it at 80%. As soon as we fund that loan, we give it to you, put it in your account, cut you a check, however you want it, but you immediately start paying on it, right? So one of those key differences, it's not revolving, right? So we talked about before, and you don't pay on just what you use. It immediately you start earning interest, and you have to start paying it, right? Another huge thing is this one is based off of your FICO, right? So the better the FICO, the lower the rate. If you have a little bit of challenges, you're going to have a higher interest rate. But with those strong FICOs, the rate right now is fixed as low as 5.50. And today's prime rate is 5.50. So you're literally walking into a fixed product on the home advantage. So it's a very powerful product because it's fixed. But if you're just looking to have that safety net, just to have it, this may not be the product for you, because remember, you're paying on it immediately, right? So those are some of the biggest comparisons, is that you really just got to know, if I take this out, I want the fixed rate, but they're advancing the money immediately to me, right? No more revolving. Another good thing is we offer on this product specifically, we offer a 10-year option and as well a 15-year option. So those members that want to get it paid down in that faster term, 10 years, you have that option, and it offers a lower rate because it's a shorter term, and you may get that 5.50. Or you can go the 15 years and draw out that payment a little bit and get that going as well for a more comfortable payment, right? Another thing to look at is sometimes members need, if you recall, the home equity line of credit went up to 500,000, right? So, but the home advantage, since we're advancing that out to you immediately, the max it is 350, right? So those are a big difference. We've had members that apply and they maybe need they need 400,000. then the home advantage isn't for them because we only go up to 350, right? So there's some key factors, and what I really want to stress is that both are great products. They just have to fit your individual needs, right? That's why we have two products. If everything was super cookie cutter and this one product worked for everybody, we'd have one product and say, here it is, it's a great product, use it. But we heard our members saying, hey, we're looking to have that fixed rate option too. I understand I have to advance it immediately, right? But I'm still would rather have that fixed rate option, right? So, and that peace of mind that it's not going to go up, right? But again, the home equity is a great product because you only pay on what you use, and the rate can go down, which we've seen. So these are some of the biggest, differences in the product itself. The schematic of the product is pretty much the same, meaning you're using the value of your home. When the value goes up, you can take out up to that 80%. But when you get to the nuts and bolts of it, there is some differences, right? And that's why when you said, hey, let's do something to put the word out there, because there is some confusion between the two products. We're having members, asking those when we see them in consumer lending. Let's get the word out so members have the time to actually kind of dive into it and say, I do need this money right away. It's worth it to me to advance it. Or secondary, I'm just going to have it more for a safety net, or I'm looking to do a project 2 years down the road or a year down the road or 6 months, and I don't want to start paying that interest immediately. So they're two really good products. The nuts and bolts are a little different, but they're beneficial to both of our members for individual scenarios. Is there any questions out there regarding anything that we covered?
Yeah. So one of the questions is, can I have both a HELOC and a home advantage loan?
Great question, but no, you can't, right? You can only have one second. So this is considered, and this actually ties into a great topic, Yari, is this is a second that you are putting onto your home, right? So we won't sit what they call in a lot of, or institutions won't sit in third position, right? So you can have your first loan, and that can be with anybody. And that is a great question, because a lot of members say, do I have to have my first mortgage with you in order to have a second mortgage with you, right? Home equity loan or home advantage. No, you could have your first mortgage with one of the other banks out there or credit unions, and we can have the second loan and the home equity or the home advantage used us for that product, right? So it's totally separate. You don't have to have them both with the same organization. And obviously we want you to have both loans with us because we have powerful products in our first mortgage too. But again, this product is you can have one or the other, but not both at the same time.
Awesome. And then another question is, so does it require an appraisal for either product or both?
Perfect. Right now we're in the we call something an automated value check, AVM. And what happens is we just go on, we have a database that actually pulls the value. And what happens is, as long as the value comes out at the amount that you need, we don't have to do a full appraisal, right? If it comes back lower, and because you got to look at, if you're doing an automated appraisal, it's not giving you any upgrade value, right? It's going to strictly say, this is the area, this is the size, this is what your property is mostly worth. But if you've updated your kitchen, your bathroom, it's not giving you any value for that. But if you get a full appraisal, someone actually goes in and is giving individual value to your property, right? And again, based on some comps, but we automatically do an automated appraisal. So, but if the value does struggle and it's down, you do have the option to request a full appraisal. So it does require it to be at the 80%, either by a full appraisal, as you stated, or an automated appraisal. We hope it just goes to the automated. It makes it very quick.
Right. So then with that being said, are there any costs to doing either product?
Yeah. So overall, right now, both have the same cost. So it's right at $550 to do the whole process, which is very minimal. And then we try to keep all of our fees down. We don't overcharge. The only time you're going to see that is with an automated appraisal. Okay, that is with an automated appraisal built in. If you request a full appraisal for some reason that the value comes down lower, and you're like, I know I did this to my property, and that's a good thing, is you're going to have a individual loan rep that you'll work with us at the credit union that will talk about that, right? If it comes back low, we're not just going to say do a full appraisal, right? Because that appraisal can be up to $550 by itself, that's a third party fee that they use, and that because someone's physically going out there. We're going to talk to you and say, you know what, why do you think your property is increased more than what this is? What have you done? Let's go through it. Oh, I redid my kitchen, I've done this. Oh, then let's do it, right? So the overall fee is 550 standard, but the only thing that will increase that is if you do request a full appraisal. That can be anywhere from 450 to 550.
Awesome. And so then, so if is there like is there a wait period? So let's say somebody just bought their house. Is there like a wait period that they have to wait in order to get either product, or they could just do it immediately?
They can do, as long as everything the property is already in your name, right? It has to be already closed, the loan closed. We do not, what they call it is seasoning. They like to call it, when you're cooking, you put seasoning on it, right? It's there doesn't have to be any seasoning on it, so you can do it if your loan closes. You can do it as well. We've had where we close them together, right? Where you have a first and then you're closing your second. They just have to close right behind the other. The second has to close right after the first, right? So there is options to do that. We don't require any seasoning. Some organizations do and institutions do, where they want you to be there 6 months or up to a year. We don't. Great question, actually.
Yeah. And then another one is how long does it normally take, like the application process from applying to funding?
Here at Foothill, we are closing under 2 weeks, which is super rare in the industry. Let me tell you that usually, you hear, oh, it's a headache. It took me 30 days plus to close this loan. We've have built this product where we are closing these in, under 2 weeks. The only thing that can hold that up, again, is we have to do a full appraisal, but we do have a third-party appraiser that we use that is very quick as well. But if we're doing the automated, we're turning these in and out, under 2 weeks, because we know that the members need it, right? So we're looking to close those as fast as we can.
Okay, perfect. And I think oh well, something. Okay, I thought I was muted for a quick second. I was like, hold on. Something that I think would probably be interesting is a lot of people don't realize that they can literally use these funds for anything they want, right? And so,
Right.
like for HELOC, is there any trend that you see people using it? Because I know it can obviously be for home improvements, but people can use it for
Yeah.
education or.
Yeah. What we're seeing actually right now is, when we say it's a rising rate environment, when they also change prime, you're seeing that credit card rates are increasing. So we're seeing members, take that money out to consolidate, right? They have, 3 or 4 credit cards out somewhere else at the average credit card rate is like 22% right now in the industry, right? So what they're doing is they're taking this out even at a prime rate of 5.5%, still a super powerful rate, drawing it out. Remember, you have 15 years to pay that back, getting that minimum payment down, making more payments to the principal of it, and paying that down. So this is a great product to consolidate, as you always, for home improvements as well. That's huge, right? You're actually taking the money to put it back in your home, right? And then what do? You increase your value, right? So I know sometimes people are worried about, I have this equity, I'm going to take it, I don't want to touch it. But if you're putting it back in your home, what you're doing is just increasing that equity as well, right? So it's really good to do that, and you're enjoying your space while you're there, right? If you throw a pool in the backyard, hey, let's do it, right? And you'll see your value go up as well. But we're not monitoring, and I've had members say, what, are you guys going to watch? Do I have to ask you what to send it? Does it have to be something to my home? That funds are available to you. You use them as you wish, right? You transfer them. It's available to you. You do it. Nobody's keeping track of what you're using it for or anything of that nature. So it's your equity. You use it. You took it out. It's powerful.
Perfect. So I think that's all of the questions. Yeah. So, all right. So to kind of end it, if anybody has any further questions, wants to apply, wants to reach out, the number is on the screen here, or you can visit our website. When you call the number for lending, it's option one.
Option one.
So yes, option one.
Yeah, that's it. Don't forget option one.
But thank you so much, Michael. I think this was great, very knowledgeable. We got a lot of really good stuff, and I hope that our members did too. So thank you so much to all of our members who joined us, and stay tuned for more of these. We hope that everybody is enjoying them as much as we are. So until next time, thank you all so much.
Thank
Bye.
you.
Have a great night.
Have a great evening. Thank you again.
Thank you.
Bye.